Kia ora and welcome to This is Kiwi Economics. Join us for a regular roundtable discussion featuring in-depth analysis on important topics impacting the Kiwi economy with Kiwibank economists Jarrod Kerr, Mary Jo Vergara and Sabrina Delgado.
Kia ora. There's been a lot of movement in markets recently. Some might even say a bit of mayhem, what with central banks cutting, politics, even some tensions in the air. What's been especially interesting has been the Kiwi financial market space, with the Reserve Bank being one of the most aggressive cutters of all central banks right now. Jarrod, you've written a great note filled with Pearl Jam quotes. What's going on in the rate space?
Oh, look, there's a lot going on, and there's some beautiful symmetry to what we're about to see. We've seen 125 basis points of cuts so far from assertive RBNZ, and we think we've got another 125 basis points to be delivered next year, and that's not factored into wholesale markets. So retail rates, retail lending rates, they can fall further into next year.
So we've got 125 basis points out of the way and 125 to come. How fast are these going to be coming through?
Rapid fire. So the Reserve Bank's pretty much told us explicitly that they're going to deliver another 50 basis point cut in February and then another 25 basis point cut in the following meeting. So that's 75 basis points in a very short space of time. And then we're going against the Reserve Bank. They think they stop at 3.5 and hit the snooze button for a while. No, we think they'll be forced to do more. We think they'll be forced to cut to 3% next year. And, you know, traders in the market haven't actually factored that in. So there's still room for some surprise on the downside.
So quickly, Jarrod, let's just talk why that 3%. What does that 3% mean?
3%'s neutral.
Which is, for our audiences out there?
Well, neutral is a concept where it's an interest rate that doesn't hurt you or doesn't stimulate you to do anything. So it's a Goldilocks rate. It's neither too hot nor cold. It's that right rate that's not going to generate inflation in the economy. So they'll be aiming for what they think is neutral, and they think neutral is 3. So that's where we're going.
So given the rate cuts, what's the outlook going forward from here for inflation, growth?
Everything, all of the above.
Everything, yeah.
Yeah, look, I think the rate cuts that have been delivered so far has definitely boosted confidence. So we're going into next year, into 2025, with more confidence. And we think that 25 is going to be a much better year than 24. Let's forget about 2023 because that was miserable. But then let's look to 2026 with a bit more optimism because we do think things turn around. So I want to put it on you, Sabrina. You do the forecasts for the team. Mm-hmm. What are your forecasts for growth, GDP? What are your forecasts for inflation? And, you know, anything else you want to talk about? I mean, how are we going to see things play out?
We are set for an improvement in sort of the general economy, but there are still a few awkward periods, a couple of months, couple of quarters that we need to get through first. As you say, this confidence needs to translate into activity. So for GDP, it's still looking like we might see one more quarter of contraction and then still quite slow growth until midway 2025. But we're hoping for, you know, a sort of fixed 26, fingers crossed. In terms of inflation, we're back within the RBNZ's 1 to 3% target band, and even better, we're actually close to that 2% sweet spot. We're at 2.2%, and our forecasts have inflation bouncing around that 2% spot, with potentially even risks to the downside more than the upside.
Yeah, and that's big, right? I mean, central banks target inflation. They seem to think 2% is that sweet spot. We're almost there. We think the risk is they undershoot for a while, which, you know, means that they can actually cut rates, you know, further should they think it becomes a problem.
So, Jarrod, obviously the Reserve Bank cutting interest rates is one driver on what we're seeing in the rate space, but there's also a lot of offshore developments going on, a bit of fears of Trumpflation. What's happening to rates in the short end and the long end, and what's the outlook there?
Yeah, so the short-term, short-end interest rates are relatively well anchored because we're expecting the central bank to deliver rate cuts. So those rates are holding, which is nice, but the longer-end rates are bouncing around. They're bouncing around on fears that Trump's tariffs cause a bit of a war, bit of a trade war. We don't like that as a small export-led nation. What do those tariffs mean? They're obviously inflationary for those involved, but if they are large enough to divert trade, then we could get some deflation. You see, there could be a whole lot of EVs made in China that were supposed to go to the United States that get diverted to Australia and New Zealand and other markets, and we get them cheaper. So there's a bit of an argument out there that maybe we could see some deflation on the back of this, but who knows? I mean, we've got to see what Trump actually delivers. And from the United States perspective, you know, he's quite expansionary in his fiscal policy. There's talk of tax cuts coming through as well. So the US economy is already doing really well, but thoughts are that grows even faster, and interest rates in the US are likely to rise on the back of that, which puts upward pressure on longer interest rates in New Zealand. So 5-10-year interest rates, they get pulled along for the ride offshore.
Okay, and so for Kiwi households listening out there, what does this mean for them?
So those short-term rates, like your 1 year, your 2 year, maybe even your 3 year fixed rate, I think will bottom next year. They still could go down a little bit further on more rate cuts, but then those longer-term rates that some households and businesses love to tap into, like a 5 year or a 7 year rate, they're going to get more expensive as international interest rates rise.
We've talked rates, and I know you love FX. So what does this all mean for the currency? Obviously, there's definitely some downwards pressure on the Kiwi, but is there any changes happening next year?
Yeah, I think the Kiwis, it's really difficult to forecast, but we do it anyway for the fun of it. Our forecast for 59 by year end 24 looks pretty good, but our forecast for next year, we see it as a game of two halves. The first half of the year, we think there's downside risk to the Kiwi as the Reserve Bank continues to cut and others don't cut as much or at all, like the RBA. So our currency will be under downward pressure. Good for exporters. Sorry, importers, things are going to get more expensive. But then in the second half of next year, I think things turn around and the Kiwi gets into a bit of an updraft, and we see it rising into year end. Not good for exporters, but good for importers coming into next Christmas.
So we're wrapping up on the year 2024. What are you looking out for next year then?
The big thing for me is that we've seen a lift in confidence, which is great. We've seen this before. It's whether it lasts. And I think with the rate cuts that are still coming through, confidence will remain strong going into next year. What we need to see from businesses, though, is that there's actually a pickup in activity. More importantly, they need to get on top of profitability. So costs are coming down, which is great. Interest rates are coming down, which is helpful. Profitability should be improved or restored next year. And then I think in line with our call that the second half of next year looks better, it's when that confidence turns into activity, which turns into investment. We need to see businesses investing again, buying machinery, expanding, and of course, we need to see businesses hiring again. They're downsizing at the moment. I think if we have this chat this time next year, they'll be expanding and hiring again.
Yeah, and we're definitely going to see some areas recover faster than others. You know, those areas that have been really hit the hardest from interest rates and maybe led the decline on the way down might actually be the ones that turn around the fastest as interest rates start to come down. So things like we'll be definitely looking out for how the retail sector performs, definitely construction, they've had it really tough, and also manufacturing, which we are starting to see a few signs of life there now. So that will be definitely what I'm looking out for, seeing how these sort of sectors recover next year.
Yeah, Yeah, and I think retail is one of those interesting ones. It's a bit like the canary down the coal mine, right? Once the consumer comes back, once households feel like they can spend more again, we might see those retail shops doing well again, which would be great after 2 years of miserable growth.
Well, Jarrod, I have to say I'm pretty excited for next year. I'm excited about the 125 basis points of cuts that we've already had, and I'm excited for the 125 yet to come. You know, yes, we still have to get through a bit of a awkward 6 months for the first half of 2025, but from there, things are set to get better, and retail rates, wholesale rates, they're all heading lower, and that's going to make a difference for Kiwi households and businesses.
Thanks for watching. This is Kiwi Economics.